This is Nightly Business Report with Bill Griffith and Sue Herrera.
Striking distance. Apple's strong quarter moves the stock ever closer to that $1 trillion mark. Summer sizzle. The market closes out its best month since January thanks to strong earnings and positive economic data. Turbo boost. Can the car that Steve McQueen made famous help Ford get back on track? Those stories and much more tonight on Nightly Business Report for this Tuesday, July the 31st. And we bid you good evening, everybody. Sue is off tonight. We begin with the latest results from the world's most valuable publicly traded company, Apple. After the bell tonight, the Dow component topped both earnings and revenue estimates thanks to sales of pricier iPhones and to continued growth in its increasingly important services business. Apple earned $2.34 a share. That was 16 cents better than expectations. Revenue was up by 17% to more than $53 billion. And investors liked the report, sending the stock to an all-time high in initial after-hours trading and pushing it ever closer to that $1 trillion market valuation. Josh Lipton has more for us tonight from Cupertino.
Apple reporting iPhone units coming in at 41.3 million in the quarter. Now, that was actually a bit lighter than analysts had expected. Wall Street was looking for 41.8 million iPhone units, but the iPhones Apple is selling carry a higher price tag, so the average selling price of those iPhones a much stronger than expected $724. I did have the chance to catch up briefly with CEO Tim Cook. We talked about a mix of iPhones in the quarter. He said if you look at the phones most recently launched, the 10, the 8 Plus, and the 8, they grew, in his words, very nicely in the quarter, and he said you could see that in the average selling price. He also said they took down channel inventories of the iPhone by 3.5 million units, so the underlying demand, he said, was even stronger. For Nightly Business Report, I'm Josh Lipton, Cupertino, California.
What next for Apple? We're joined tonight by Angelo Zeno. He's an equity analyst with CFRA Research. Angelo, thanks for joining us tonight.
Thanks for having me.
I'm struck by what Josh told us. They sold fewer iPhones than Wall Street expected, but at a higher price point than Wall Street expected. The strategy seemed to work to sell those expensive iPhone Xs, yes?
Yeah, absolutely. I mean, we were looking personally for about 42 million units, came in at, like Josh said, at 41.3 million. So I'm disappointed on that front, but those average selling prices, boy, I mean, typically you see a drop significantly in average selling prices as you go through the cycle here, the June quarter being the trough of the cycle. And, you know, given that we saw the type of numbers that we saw, I mean, it's just a testament of, you know, what Apple is doing here and their capability of charging higher average prices, and consumers loving that.
Services business was up 39%. That's a continued growing business for them, isn't it?
Yeah, when we look at the actual bullish view on Apple, I mean, it really has to do with services, one, and two, it's the wearables category. And right now, they're really kind of hitting on all cylinders when it comes to both, growing north of 30% in both segments. Are there any tariff issues, any trade issues, or other headwinds that are facing Apple right now that you're keeping an eye on? Yeah, I mean, I'd say the biggest concern has to be, you know, what goes on with China here from a broader kind of trade perspective, a political perspective. But that being said, when you look at China growing 19% year over year for Apple, Apple is doing very well there. And our view is they'll continue to do well, barring any unforeseen circumstances between the two, global titans. Quickly, we mentioned they're trading in all-time high territory right now, close to $1 trillion market cap. Would you buy the stock here? Yeah, I mean, we would. I mean, we think, we're big believers that cash is king here, and there is no better company out there at generating cash than Apple is. And, we do expect the buybacks to remain very aggressive, and, we think it's a very stable business. So right now, yes, we would consider buying the shares despite the record highs it's at today. All right. Angelo Zeno with CFRA Research. Again, thanks for joining us tonight. All right, thanks for having me. Otherwise, the tech sector bounced back in the market today, and that helped the Dow and the S&P close out July with their biggest monthly gains since January. The Dow rose by 108 points to 25,415. The Nasdaq added 41. The S&P was up 13. And for the month, the major indexes were all solidly higher.
But oil recorded its worst monthly decline in 2 years, falling by more than 7%. Bob Pisani takes a look now at what worked and what didn't for investors in July.
It's been another good month for stocks, with the S&P 500 up nearly 4%. The key story moving markets has been the continuing strong economy, coupled with strong earnings that are coming partly from tax cuts, but mostly from higher revenues. It's combining to keep the markets just shy of historic highs. There have been a few hiccups along the way. A small group of companies have been affected by higher costs associated with steel and aluminum tariffs, like Whirlpool and General Motors. We also had a mid-month swoon in tech and consumer discretionary stocks, as several big names like Facebook, Twitter, Netflix, and a few others gave disappointing growth guidance. But the market barely budged because investors rotated out of those high growth names and into value names like retail stocks, energy, some banks. And that's why the market's been so strong. When one group weakens, even a leadership group like technology, investors don't just come in and sell off the whole market, they buy other sectors. So trade issues have continued to move stocks at the margin in July, with just rumors that the U.S. and China have restarted trade talks today, helping boost the markets. July also benefited because a lot of the old market chestnuts have not worked very well this year. Sell in May and go away, remember that? That's a famous one, but we're up 6% since May. That didn't work. There's also the presidential cycle swoon, as we call it. The market tends to behave poorly in the 2 quarters going into the mid-year presidential cycle. That hasn't worked either. We're up 8% since the start of the second quarter. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
Bob just mentioned the reports of U.S. and China trade talks. That helped lift stocks as well today. There was a lot going on in D.C. Kayla Tausche has some of the details from the White House for us tonight. First, on the trade relations with U.S. and China, they've agreed, at least now, to talk again, right?
Well, Bill, the Treasury Secretary has acknowledged that there are channels of communication open, but he's doubted the effectiveness of those talks. A source that was briefed by Secretary Mnuchin within the last week on talks with China said that Mnuchin wants to see progress and wants to move toward a deal, but that he's not feeling the intensity and the pace in those talks to really move forward. The U.S. does have 2 tariff deadlines coming up in the coming weeks, and administration officials say there's no sign now of backing down on those.
The NAFTA talks. Sounds like we're close to a deal with Mexico, yes?
Well, the incoming president of Mexico certainly believes that those talks are near clinching a deal. He said so to Reuters today. U.S. and Mexican officials, Bill, are going to be holding formal talks here in Washington on Thursday. But there are 2 questions about that agreement. Number one, how broad is it? Does it cover all principles that the countries are talking about? Or is it a narrow agreement just dealing with one portion? And that portion is auto manufacturing. So that's one question. The second is, how do these countries plan to convince Canada to come back to the table? Of course, this is a trilateral deal, and there are 3 countries that would need to be involved.
Indeed. Kayla Tausche in Washington, thanks for joining us tonight. Elsewhere, in other news today, Federal Reserve policymakers began their latest 2-day meeting today with a decision on interest rates due tomorrow. But ahead of that meeting, Steve Liesman asked a number of money managers and strategists about risks to the economy, and it turns out the Fed is one of them.
The latest economic outlook shows good times ahead, but with a couple big asterisks to the forecasts. The CNBC Fed survey sees growth accelerating according to the 42 respondents, fueled by tax cuts and deregulation. But rising interest rates from the Federal Reserve and the president's trade policies represent serious threats to growth, according to the respondents. The Fed is expected to hike rates 4 times this year. That is twice more in quarter-point increments, and 2 to 3 times next year. But eventually, the Fed could hike rates enough to slow growth.
As long as we're growing better than 3%, they'll try to break the economy's momentum, try to achieve that soft landing. The problem with the soft landing is it's soft.
53% of respondents, who include economists, strategists, and fund managers, think the Fed will raise rates above neutral. That is, act to slow the economy over time. They may not have to do that if new tariffs and retaliations from trading partners actually slow the economy.
The real risk is that global economic growth will slow, and that would slow our exports, and it would eventually fall back on our economy. But other economies around the world would start slowing well before we would.
Kevin Gittes of Raymond James Financial writes in response to the survey, while the U.S. economy still has solid growth potential in front of it, you still get the sense that it wouldn't take much to watch it derail, with a high degree of confidence that Washington will be the cause of the derailment with its trade policies or some poor decision making at the top. Just about 60% of the group approves of President Trump's handling of the economy, but similar percentages say his tariff policies will reduce economic and job growth. That is, they would take away from growth what the tax cuts will help achieve. For Nightly Business Report, I'm Steve Leisman.
Time to take a look now at some of today's upgrades and downgrades. We begin tonight with CBS, which was downgraded to market perform from outperform at Cowen. The analyst there cited the distractions of the investigation into the allegations against CEO Les Moonves. Price target $50. The stock rose more than 2% today, though, to $52.67. Caterpillar was downgraded to equal weight from overweight at Barclays. The analyst cited the company's limited ability to expand its profit margins. Price target $155. Nevertheless, the stock did rise another 3% to $143.80 today. Twitter was upgraded to neutral from reduce at Nomura Instinet. The analyst there says that Twitter's investments will benefit that company long term and lead to a more engaged user base. Price target $31. That stock rose 1.5% today to $31.87. Still ahead, a classic case of too much supply and not enough demand.
I'm Contessa Brewer. This is the equivalent of the 37 pounds of cheese every American eats every year. But there's a record amount of supply of cheese in cold storage, so each one of us needs to eat an extra 3 pounds to tackle the oversupply. The economics of extra cheese coming up.
Facebook revealed today that it had deleted a handful of fake accounts. The social media company pulled down a network of pages for what it called coordinated inauthentic behavior. It has not officially identified who was behind those accounts, but they did say that there are some similarities with those run by Russian trolls ahead of the 2016 presidential election. An Ohio Chipotle restaurant has reopened as an investigation continues into possible illnesses related to that location. Chipotle closed that restaurant yesterday after hearing from 2 customers who said they fell ill after eating there. This is the first major food safety issue for Chipotle's new CEO to deal with. It has been 3 years now since the original E. coli outbreak that damaged the company's reputation. The stock fell nearly 7% on this news today in trade. Well, America's cheese stockpile is rising, and right now there is a record amount sitting in warehouses around the country. And that excess supply is bad news, of course, for the country's cheese producers. Contessa Brewer is in Menands, New York for us tonight.
Sean O'Connor founded his company, R&G Cheesemakers, 9 years ago. But it's a tough job turning his dream into economic success.
You're paying up front for the raw material, the milk and other ingredients. And then if you're aging cheese, you're waiting however long to realize your profits, assuming that you're able to sell it.
If they can't sell it, it sits in cold storage. And the USDA says there's a record amount of cheese sitting in refrigeration, nearly 1.4 billion pounds. Part of the issue is cows are producing more milk than ever, but American milk consumption has been declining for decades. So the big dairy guys have worked intently to open new global markets. Mexico is the #1 foreign destination, receiving a quarter of U.S. dairy exports, and last year climbing 8% from the year before. China, the 4th biggest export market, grew 49% from 2016. Both countries have now slapped U.S. cheeses with retaliatory tariffs of up to 25%. And Canada, another top taker, at a certain point hits American dairy exports with duties of up to 275%.
We are exporting about 15% of our production. So we depend upon trade agreements. We need a functioning marketplace. having uncertainty in the market is not a positive thing.
Big manufacturers are already reporting declining sales and stalled contracts, but the big concern here is that their customers could move permanently to cheesemakers in Europe or Canada. And under new trade deals, specific cheese labels would be restricted. So, for instance, Parmesan would only come from Italy, or Feta would only come from Greece.
They can do two things. They could try to find different markets to go after, to try to move some of those products if China and Mexico don't currently buy them, or they could sell it domestically here at a lower price.
That's a real worry, even for artisanal cheesemakers like Sean, as he sends his supply to farmers markets, restaurants, and Whole Foods.
Where I see it potentially affecting me is the companies who are producing a lot of cow's milk cheeses are going to start to really be aggressive in the United States market, which then would make it harder for me to compete, in the supermarkets that I'm in and the supermarkets that I'm trying to get into.
But until new trade agreements are in place, the uncertainty remains, and the cheese remains on the shelf. For Nightly Business Report, Contessa Brewer, Menands, New York.
The stronger dollar weighs on Pfizer's sales outlook, and that's where we begin tonight's market focus. The drug maker lowered its full-year revenue forecast, citing the strengthening dollar. The revised guidance came after Pfizer reported stronger than expected earnings, which were led by higher sales of some of its key drugs. Pfizer also said it plans to ramp up investments in research and development in order to bolster its current product pipeline. Shares rose more than 3% today to $39.93. Procter & Gamble said that increased investments and growing competition caused its sales to rise at a slower than expected pace, especially in the consumer product giant's shaving business. Earnings overall, though, were ahead of expectations, and P&G said that it would raise prices on a number of its products in response to higher commodity costs. Shares of Procter & Gamble rose nearly 1% to $80.88 today. French drug maker Sanofi topped profit estimates, but it did see its sales come up short as weakness in its diabetes division hurt results. Sanofi is betting that recent acquisitions will position that business for growth in the second half of this year. Shares finished up 1% today to $43.36. And health insurer WellCare topped profit expectations, with results being helped by higher premiums and lower medical costs. The company said that it's seeing strength across its businesses, and as a result, it is hiking its earnings outlook for the full year. Shares climbed by 7% today to $267.42. Meantime, Ford is hoping the return of a classic car will give the automaker a turbo boost. It is bringing back the Bullitt Mustang, named, of course, for the classic Steve McQueen movie. And where better to test drive that new Bullitt but in the city that made the car famous, San Francisco. Phil LeBeau takes us for that ride.
The sound says it all. Ford's new Bullitt Mustang, complete with the throaty roar from its V8 engine, is rolling into showrooms, a reminder of the automaker's glory days.
It's a part of the heritage of the company. It's part of what Ford's image is built on, and it gives people something beautiful that they can look at and say, that's a Ford.
50 years ago, the movie Bullitt, with Steve McQueen driving the Mustang in a high-speed chase through San Francisco, made the Bullitt an American classic. These days, there are fewer muscle cars on the streets, but they still generate emotional reactions, which is what Ford wanted when it had McQueen's granddaughter Molly introduce the new Bullitt earlier this year.
I got emotional when I saw Molly McQueen talk about that car, because it's the idea of the history of Ford, where it's been a leader in categories like Mustang and F-150, not resting on its laurels.
Right now, Ford is struggling. The automaker is restructuring its operations to boost profits. Meanwhile, plunging sedan sales has Ford planning to stop building cars, with the exception of a few models, like the Mustang. In short, this is a company looking for a little bit of buzz, which is what the Bullitt is all about.
If you've got one particular car that people get excited about, one car that the brand becomes associated with positive connotations, that can only help.
A blast from the past, looking to rev up sales and the attraction of muscle cars. Phil LeBeau, Nightly Business Report, Sausalito, California.
Coming up, rising risks, how extreme weather is putting an historic Main Street underwater. Quick look now at what to watch for tomorrow. The Federal Reserve, as we mentioned, will conclude its two-day policy meeting and issue its outlook on monetary policy. Automakers will report sales for the month of July. And ahead of the government jobs report on Friday, ADP will release its private payrolls report for July as well. And that's what we'll be watching for on Wednesday. The Northern California wildfires are leaving a trail of destruction. More than 100,000 acres have burned at this point. Firefighters are making progress, but already lives have been lost and homes and businesses have been destroyed. It's early, but Wall Street is already starting to analyze the impact. According to Keefe, Bruyette and Woods, primary insurers rather than reinsurers will probably bear the majority of the losses incurred so far. Horrific scenes from a deadly flash flood in small-town America over Memorial Day weekend drew national attention. But now the cameras there are gone, and locals have to figure out what to do next. The problem is the rivers. A combination of climate change and too much real estate development has turned water from an asset to a liability. Diana Olick has the next part of our series, Rising Risks.
It would have been called a 1,000-year flood if the same destructive deluge hadn't crashed through Ellicott City, Maryland just 2 years before. The first time around in 2016, on the city's nearly 250-year-old Main Street, shop owners like Donna Sanger worked tirelessly to rebuild.
There was this enthusiasm, let's put on a show, let's bring the town back.
But this time,
this is more like a funeral.
Now they feel like these destructive floods are the new normal because this historic town, barely a blip on the map, is a blueprint for developing disaster, real estate development, in the face of increasingly wet weather. Joe Sexton is a scientist who uses satellite images to map changes in ecosystems.
You had two 1,000-year floods within 2 years of each other. How did that happen?
The overwhelming factor was intense rainstorms. Climate change due to warming oceans, changing atmospheric patterns, more water is falling. On top of that, we're intensifying land use, which is clearing the natural vegetation and replacing it with impervious surfaces like concrete, asphalt, through which water does not penetrate.
Ellicott City was built just north of the Patapsco River. Several tributaries above its main street run through the town to the river. Those water currents were the energy for this town, built around a mill in 1772. But since 1991, real estate around the popular Main Street exploded. Developers submitted more than 100 plans to build residential and commercial buildings in about 3 square miles around the city. Most were approved.
We have flood maps that were drawn based on conditions that are no longer true.
In the most recent storm, nearly 8 inches of rain fell in just 3 hours. Intense water with nowhere to go. Sexton's maps show how development increased the intensity of the flooding by up to 30%, and Ellicott City is just one example. He mapped close to 8,000 square miles between Washington, D.C. and Baltimore and measured changes since 1984. The amount of land or permeable dirt illustrated here in red that has been covered with impermeable streets, sidewalks, and buildings is about equal to the size of the entire city of Baltimore.
When we think of the destructive power of rivers, we tend to focus on the amount of water, heavy rains causing tributaries to overflow. But it's also the speed of that water, rushing through towns like a bulldozer. So how do you control that speed? Well, you can't tell a river what to do, but you can give it new options for where to go.
Alan Kittleman has been the county executive for the area that includes Ellicott City for the last 4 years, leading its people through both floods.
We're not going to lose this town, but we need to realize instead of imposing ourselves on the river, how can we coexist with the river?
The answer, he says, may be in a transformative vision, literally taking down some of the historic buildings by the river to give the water more space.
This is gorgeous, historic real estate. You really feel like you could have to pull some of it down?
I think we have to look at what's best for the town as a whole. We have to figure out what is the best way for us to save this town. And, you know, the river runs underneath all these buildings right here.
One of those buildings houses Tom Shoemaker's family furniture business. He and his son barely escaped the floodwaters.
And the water kept coming up, and it started seeping through the doors. Then all of a sudden, it just, boom, broke the doors.
He's lived in this area for nearly 50 years, but leases this space. Now he's going to move his business uphill.
Being down here in the flood zone is not fun. It's difficult.
On the other hand, and the other side of the street, the change could benefit other businesses, like Donna Sanger's. She owns her building and is invested in what the town decides. That's why she's rebuilding.
If we can get through that period of time, then it's a tremendous opportunity, too.
Because taking down the opposite buildings means her property would overlook a valuable new green space, a river walk, mitigating water and attracting business to her and her neighbors.
And they know that if they hold on, they bring the buildings back, and the county does what we think they're going to do, that in the long run, they're going to have very valuable real estate.
For Nightly Business Report, I'm Diana Olick in Ellicott City, Maryland.
To read more about the rising risks to real estate, you can head to our website at nbr.com. That's Nightly Business Report for tonight. I'm Bill Griffith. Thanks so much for watching, everybody. Have a wonderful evening. Hope to see you again tomorrow.